Shayna Orzik-Sissel, how we doing today? Excited to have you on, CAIA President and Chief Executive Officer at Banríon Capital Management. Welcome on.
Thank you so much for having me. Excited to be here.
Let's go ahead and talk about what everyone's talking about, of course. Will the Fed mandate on inflation induce a recession? Or maybe you're in the camp that we're already in a recession.
So I am not in the camp that we are already in a recession. The economic numbers continue to be stronger than people expect. Spending continues to be strong. Consumers are actually levering up their balance sheet for the first time since before the pandemic. And that has only started in the last quarter or two. So I don't think we're in a recession just yet. It's very hard to be in a recession when employment is as strong as we are today. People always think, employment, that'll go up before, but employment numbers are always lagging. So just keep that in mind, but very hard to have a recession when we have employment numbers as strong as they are today. We continue to have more jobs than people looking. Unemployment numbers remain low. So I do not think we are in a recession, but I do think we are headed for one. And I do think the Fed is going to push us there. They've been very clear. Chairman Powell has been very clear in his language that there was going to be pain. I think his choice of words is deliberate. So I think he's saying that because he believes that. And so I think that they intend to continue through this process to attempt to get that Fed funds rate to 4.25%, 4.5% is sort of that target number they're focusing on. The Chicago Fed chair reiterated that today. And I think they're very fixated on that, and they will do what they need to do in order to get us there, even if that means putting us into a recession.
Sounds like no soft landing, but of course, this Thursday, we're going to get that economic data to come in, right? Will the CPI report change the outlook or narrative?
I don't think it will. Somebody pointed out this morning on one of the other networks that CPI has come in hotter in 18 of the last 19 reports. I don't think that trend is going to change, quite frankly. And so I anticipate that the number is going to continue to be hot. We're going to continue to see strong employment. And as long as that's the case, the Fed will stay its course, continue with QT, continue with its rate hike, and until they have a reason not to. And I just don't think they have that right now.
Of course. Now, one thing that we're watching and everybody's starting to really kind of focus on is the midterms and what kind of impact that's going to have on the markets. What do you feel will happen?
So it's really interesting because midterm elections are usually really good for markets. If you look back in time, and you can go back decades, the market usually is very strong following midterms. As a matter of fact, I'm going to quote this wrong because I don't have it directly in front of me, but I think it is a fact that after every midterm election in the last 50 years, the markets have been double-digit positive in the following 12 to 18 months. I might be slightly off, but it's definitely the majority of the time. I think that will be the case this time, assuming the midterms go as people expect them to, which is you start to see a change in leadership in Congress. I think a lot of people expect Republicans to take over the House and the Senate. I, for one, don't think it's going to be as significant a majority, but I do think it's going to happen. Assuming that does occur, I think that the markets will react positively in 12 to 18 months. We'll continue to see the trend we've seen after every midterm election. Even in spite of a recession, a lot of people, again, I get a lot of flack for this, but people forget that the markets are forward looking. And so they tend to recover 6 months before a recession ends. And they start to slide 6 to 12 months before a recession begins. So with that in mind, I think the midterms are actually going to be good for stocks. And we should keep that in mind as we're positioning portfolios.
Now, Shayna, of course, we've been recently seeing financial instability, and now the question really starts coming up. Will the Fed crack, break something as they continue to hike these rates?
I think the probability of the Fed breaking something is higher than them not. Historically, the Fed always makes a policy mistake. And if you look back over time, it's usually because they act too late, and that's the case here. They were doing QT until March. Or QE until March. They didn't stop. their quantitative easing until March, and they should have started that well into last year when they started to see, even before they started raising rates. That would have been, to me, the logical thing to do is start quantitative tightening before raising rates, but they didn't do that. And so policy mistakes have occurred. We've already seen the Fed talking about pain, expect to have unemployment increase, expect pain on Main Street. All of these things, I think, are deliberately chosen language. Then we should expect that the Fed has already made a mistake and they probably already broke something. That's typically what happens, not the other way around. It's very rare that the Fed does not make a policy mistake.
Well, if anything, maybe 20 years from now, they'll still win a Nobel Peace Prize, but we won't get into that.
Yeah.
Let's talk about what areas do you see for opportunities or ways to balance portfolios here in a rapidly declining market?
So anybody who follows me knows that I'm sort of the alternatives queen. I always am talking about using liquid alternative ETFs in particular to help hedge portfolios. And when I say that, I don't mean using hedged products per se. I mean actual diversifiers. So for example, again, this is a name I talk about all the time, have been talking about for years now. But an ETF like BTAL, which is, I'm going to just take a look, year to date up 14.79%. Yes, positive 14.79%. That's a fund that I really like right now. I think in a highly volatile market like we're seeing, where there's a ton of uncertainty and a likelihood of a recession, this is a product that people should have in their portfolios, not just tactically. This is actually something I keep in my client portfolios and I recommend through any period of time as a diversifier. But right now, I think it's a particularly timely opportunity for this particular fund. I also like other liquid alternatives. Like if you really are looking at, I know you were talking about this earlier, the ways that this is impacting the geopolitical, the macroeconomic, and even the policy decisions that are being made are affecting some of the energy market. So something like FMF, which is a managed futures ETF that goes long and short, that's another one I really like right now. Again, positive year to date, 15.23%. Again, positive 15.23%. I can't emphasize enough. These are diversifiers that also take advantage of some of the uncertainty going on in specific markets right now. So that's actually where I really am spending a lot of time talking to people, because these are not areas people have looked at before, and many people don't even know some of these products exist. If you want to talk about stocks, though, one of my favorites right now is a stock, Leidos, LDOS. Another stock that is actually positive year to date, up 3%, which doesn't sound like much, but in today's market, that's a win. This is a government contractor. They have a very diversified product line. I'm sure if you've been in the airport, you've seen Leidos all over, the security checkpoints, because if you get queued to go through this stupid machine, you know the one I'm talking about. That is a Leidos machine. So they do a lot of different things, but they have a really interesting health science business, both military and civilian, which is sort of their fast growing and profitable product right now, or business line right now, that I think is really interesting. Not a lot of people talking about something like this. They do have some wartime defense exposure, but not like a Lockheed or anything to that extent. So I think this is a really interesting play in a recession. Any type of company that has a significant amount of their profits related to government spending tends to do okay, because governments tend to spend more in recession than they do outside of recession, the past few years notwithstanding. So this is a stock I really like too. There are some other names I like, really beaten up, and specifically in housing, Camden Property Trust. I also am willing to dip my toe in some of the tech companies. I really like Marvell, but there's some, macro pressures and some policy pressures there that are concerning. It really just depends, where you want to make an entry point. A stock that's down 50% year to date might be an interesting stock if you think longer term it's going to be positive for you. That might be actually a good entry point, and maybe you shouldn't be scared of a stock that's down 50% year to date.
Yeah, last question was exactly on kind of that kind of stock. Marvell is, what do you think about the tech stocks with kind of AMD's pre-announcement. We had Micron, NVIDIA kind of getting hit. And it seems like you feel this is an opportunity. Why Marvell Technology specifically?
So I actually really do adore NVIDIA. It's a stock that I started following when I got into the business in 2001. So I have a soft spot for NVIDIA, but I like Marvell better because it has less consumer exposure. It's more 5G, cloud storage focus, whereas NVIDIA has a heavy consumer component. And if we're going to go into a difficult period for the consumer, it's going to hurt a stock like NVIDIA more than it is for Marvell. So I think you'll get a better entry point for an NVIDIA. Should we move into a poor market for consumers, whereas Marvell is a little more insulated from that. And so that's why I have a preference for Marvell right now.
All right. Well, you guys have it. The queen of alternatives here, Shayna Orzik Sizzle. And I will throw up your Twitter here so that everybody can give a follow to go ahead and follow the queen of alternatives. And I appreciate you bringing in some of those funds because, like you mentioned, a lot of investors just don't know what's truly out there to add to their portfolio to really bring in some diversification. Because as we see with most ETFs nowadays, they're just like a copy of another, right?
Yep. And you get a lot of these option overlays, which people think are alternatives, but really they're just hedged equity beta. So you're getting less exposure to equity, but you still have equity exposure. Whereas something like BTAL has a beta of 0 and has correlation to equity of 0 because of the nature of how that product is designed. So, people don't tend to see these products or understand how they can work, and that's why I like to bring them up. I also like to say that I did not anoint myself the queen of alts. I give Cynthia Murphy of ETF Think Tank is the one that did that. I just have gladly taken and run with that title. So I use it as much as possible now that somebody has anointed me that.
Hey, once they anoint you, you got to run with it. I can't blame you for it. Appreciate you coming on today, Shayna. We'll definitely have you back on.
Awesome. Thanks for having me.
Thank you. There you guys have it, our guest interview today. I hope that you guys were able to get a little edge from that conversation.